And then I have to find, let's see where Tony put the picture.
Ring Central.
Oh, you put the picture in Ring Central? That's why I have to ask you, you put it in, it was faster. You put it somewhere else. Oh, that's way better. I think we'll see what it looks like. So, just change my view. Exit full screen. Okay, good. So get the door open. Hi guys, we're getting everybody in the room here. We've got our presenters, which is awesome. And then I also have to make a quick, I can't make that picture. Okay. Let me also get all the other things that are open on my desk off. So there you go. Way too many screens. Tony, how many windows do I constantly have open on Outlook?
I don't think anybody here even wants to know.
You're probably right about that. So we're going.
My brother.
What's
I
that?
do the same thing. You must be my brother. I do the same thing.
Every time I share that screen, people like their heads blow up. They're like, how could you have that many tabs open? I'm like, is it a problem? I don't know. It seems to be okay. I'm going to need that information later.
Yep.
Speaking of information, everybody is signing on to get some information about Ask the Underwriter. So before we begin, many folks here are enjoying their Jimmy John's sandwiches from wherever they're watching. And as such, that was sponsored by Vienna Peterson. She is with American Family. And Vienna, I'm going to let you talk a little bit to the agents that are here and introduce yourself to them.
Hi, my name is Vienna Peterson, and I am a franchisee with American Family Insurance. So I do not broker anything out. It goes all directly through American Family. We're located on the corner of Addison Road and St. Charles Road in Villa Park, Illinois. We have 5 wonderful staff, one of them being out of state in Arizona, and the rest are here in Illinois. And we speak 3 different languages in the office. So between all of us, there's 3 different languages that we speak. We specialize in homeowners and commercial insurance. And yeah, I take a very different approach when it comes to insuring somebody. My approach is a little more old-fashioned than most. I like to be very hands-on with my clientele. And yeah, we would love to help any of your clients out that we can.
So a couple questions for you, Deanna. You mentioned 3 languages, but which 3 languages?
We speak English, Spanish, and Hungarian.
There you go. There you go.
And
you speak Spanish too, right?
I do. Yeah, I speak fluent. I speak all 3 fluent.
Nice.
And
Nice.
then
Very
we
good.
have 1, 2, 3. We have 3 of our staff members that speak fluent Spanish and English.
Perfect. Perfect. That's awesome. And then since you have somebody in Arizona, do you also insure Arizona from your location?
Yes, we are licensed in 9 different states now. The states that we are licensed in, and actually I'm about to take over another book that's in Elgin. So we're spreading out a little bit here in Illinois, but we do insure in Indiana, Wisconsin, Arizona, Ohio, Iowa, Nevada, and oh my gosh, there's 2 other states. I'm sorry, I'm not quite sure which ones they are.
No.
But we do insure in all of those states. Oh, Florida is one of them.
There you go.
We just have a lot of clientele that is retired, and we just took the jump and we went ahead and got licensed and bonded in Florida.
Well, you have a lot of people thanking you in the chat, which is something that I wanted to share with you guys. So we got a bunch of questions that came in ahead of time, which is good. We'll be going through those questions with our underwriters. And then as you guys that are here in attendance, feel free to ask us questions. And certainly if you've got questions for Vienna too about insurance, we'll let her answer those questions as well. I have to do a quick, we're not doing a presentation. However, I guess when we're talking about underwriters, we're taking you into, one of our agents said they're very excited to get into Gringotts Bank. I think that's how you say that. I'm not a Harry Potter person, but apparently this is where the underwriters hang out. Did you know that, Kim and Jolene, that you guys
No.
hang out here? Do not hang out here. So anyway, we thought it was funny. This is the bank, apparently deep in the depths of the bank of Harry Potter. So with that, before we get started, Kim, do you want to introduce yourself as far as how long have you been with us and how long have you been in the mortgage business?
There's that old joke, right, of how many people tell you how long they've been in the mortgage business, and you're like, oh God, here we go again. But my name is Kim Martin. I'm VP of Underwriting here at Cross Country Mortgage, and I've been with Cross Country 5 years. I think I've been with Rich probably 4 of those 5 in some capacity, which has been a really great experience for sure, learning Illinois, because before I came to Cross Country, I did not do Illinois at all. So it's been fun. How long have I been in the mortgage business? 28 years. I'll just say that 28 years, because I have a 28-year-old daughter and I was pregnant when I started with her. So yeah, that's that. And I went through the whole gamut of everybody who remembers subprime. Yes, I did start in subprime. Wah wah. And then had that nice little stint of where everything crashed in 2007, 2008. And then Vienna, I even went to insurance and could not hack it. So the second I could get out, I went back into mortgage. So here I am. And my goal, I'll tell all of your agents on the phone, I'm here in Denver, Colorado, and most of our underwriters work remote, but my retirement plan is to try to attempt to become an agent here in Denver. And I tell you, I am very scared about that, but I think it would be very interesting. And
real estate agent?
Yeah.
Oh, neat. Well, that's interesting. That's a lot more than Jolene and I thought we were going to get. So Jolene, we're side by side.
I can't follow that up. Sorry, guys.
Jolene, that's okay.
And then let me introduce you to my right-hand person, which is Jolene, who is my amazing counterpart. So Jolene.
My name is Jolene Hood. I have been with Cross Country for just over a year. I've been in the mortgage industry for about 12 years, but before that I did I worked at a bank. So of course we did other kinds of lending. I started after, of course, the 2008. So I hear stories, but thank goodness I wasn't in the middle of that. So yeah, I've worked for Kim the whole time I've been here. And I think I started working with Rich not long after I came on. So I think it's been about a year as well.
Almost.
So yeah. Currently I have 14 underwriters that report to me. And it's been a crazy year. It started off kind of slow and it's ramped right up, and we're just really happy to be busy. So and I don't have any retirement plans. I just pay as I go.
There you go.
I just play.
Invest in real estate, Jolene. I have some agents here that will help you with that. So that's good. All right, guys. So as I mentioned before, you guys have already been hitting the chat. Please bring your questions in the chat. You guys were great enough to give us questions as you registered. So I'm going to just start from the top in here. So Destiny, I don't know if Destiny, if you're here, throw us a hello. Destiny asks, if you co-sign on a vehicle, will it be counted in your overall debt? But she continues, how can you prove that you're not paying it so it will not be counted in your overall debt? I don't know which one of you guys wants to take that one.
I'll take it. I'll leave the hard ones for Jolene. This one is a difficult one though, for sure. When you do co-sign a debt, it is your responsibility. But if you have evidence that the co-debtor, right, the other person has made the payments in the last 12 months, then we can omit that payment from your debt to income qualifying, or the borrower's debt to income qualifying. The other catch with this is that those payments have to have been made on time for the last 12 months. So if they were late at any time, meaning over 30 days late, then unfortunately that debt cannot be omitted.
And that to prove that off of them, it's 12 months worth of canceled checks
Canceled
or
checks.
transfers from a checking. But the key to that account is that our borrower, or the person that Destiny is asking about, the cosigner, if you will, is not on that account. So hopefully it's not a joint account, checking account should be paid from an account for the signer, not the cosigner. So Destiny, thank you very much. Oh, and by the way, Destiny, happy birthday. All right, next question we've got is from Raven. She asks, what things can affect a deal, a transaction, from the time of approval to closing? So obviously there's a million of those things that can come up. So what I'd ask you guys is, what are the most common things that you see come up that might change somebody's pre-approval before they get to closing?
I think the biggest thing that we see is if someone opens new debt. That happens a lot. So if they're out there looking, they need to really wait until after the loan closes before they incur any more debt, for sure.
That's a big one.
Yeah.
Yeah, and I've actually seen, and this will be a great follow-up question to that. We've had people open up debt after they were clear to close. Can you ladies explain why opening up debt after you're clear to close, but before you close, is a bad idea?
Well, what happens is, as all of you who have mortgages know, that the loan is transferred either to the agency or we service it or another servicing agent. At that time that the servicing agent sees that we close the loan, they still will monitor for any undisclosed debt. And if that debt pops up anytime in between that servicing contract date and their close date, they can still come back and ask us, why did this person open up more debt? Now they don't qualify because their debt to income ratio is higher. So that's why we ask for a little bit of a cushion before they start buying cars and furniture.
Yeah, and the one thing that you guys should know is, prior to us getting that package out to closing, we are going to check one more time to see if they've had any recent inquiries. And then those recent inquiries will have to be explained by the borrower, and it could have potentially a negative effect on that. So that's the most common thing, is new debt. Anything else you guys wanted to add to that?
Oh, there's a lot of things, right? Like Jolene had mentioned, and Ron, and we all know what will stop us, right? The other thing with approving, right? We usually look at credit, we look at income, and then as much collateral as we have. If we don't have an appraisal at the time we underwrite it, of course, those appraisals, those are tough. If the appraisal doesn't come in and we can't get value up to where we need for the purchase price, that can always create an issue. That is something that has come up lately, as of late. And I think we have another question that
we got a lot, and we got a lot coming into the chat, so I'm excited.
I know, I
love the interaction, so it's good. All right, so Kim and Jolene, what would you say the advantages here, this is from Juan, the advantages here across country are through your underwriting viewed versus underwriting maybe at a different company? It sounds like Kim's going to take that.
I think the advantage to me is we don't have a lot of overlays to the agency guidelines. I think that is a huge deal.
Can I stop right there, Jolene, before you finish that?
Yep.
So an overlay is an extra rule that the company puts on the basic guidelines that are given to us via Fannie Mae, Freddie Mac, FHA. So they have their core set of guidelines. However, other companies say, you know what, we're still not comfortable, we're going to create extra rules. And what Jolene's saying is that we don't do that here. Go ahead, Jolene.
No, that's a great analogy. A lot of other places do add certain items to minimize their risk. Where here at Cross Country, we take pride in reviewing the entire file, and we don't have to add those risk layers. So I think that's very important.
That's great. Kim, did you want to add anything to that? That's a great answer though, Jolene.
Well, I would say, just getting to the heart of it, I think we do things better here at Cross Country, which is what kind of back to what Jolene had said. We make a deal work when we can make a deal work. If there's no way to get a deal done, then we've exhausted a lot of opportunities, anything we can go through. For me, it's more of an emotional thing of why I like Cross Country. Is I like Cross Country because I like the relationships. I like that I'm able to call Rich and go, hey, this isn't going to work this way, but can we do this? And, can we have the borrower, tell us this, will this work? I think that at our core, if you've noticed, Cross Country has really grown. And I think with that growth, that is all of the loan officers and all the sales managers at their core being willing to work and really make us a better company. Other companies that I've worked at do have those overlays, and that stifles their business tremendously. And a lot of the loan officers don't know that. So as you work with other companies, other loan officers, they may not have a good relationship with their underwriting department. They may not have a good relationship with their closing department, and they don't know the pitfalls that are going to happen. Here, we all get along. Like, we talk all the time, and we are working through files, and the experience level here is super.
Yeah,
So,
it's really fantastic, because I think, you were talking about other companies just don't know. And I'm going to close out with this because we got questions piling in the chat. But I've had a real estate agent call me, or a client call me and say, hey, we can't go FHA because FHA doesn't go below 620. And I'm like, well, no, the lender you talk to doesn't go below 620. FHA goes way below 620. So that's a good thing. And it's just a matter of, that's what their company taught them.
Yeah.
They don't know any different.
Yep.
John has an interesting question. He's always has great questions. I love having him here. Has the current infatuation with AI given us any inroads on the mortgage business or the underwriting process? Has anything changed yet for you ladies?
yes.
Oh, nice. Okay.
Go
Yeah,
ahead.
go ahead. No, you take it.
We have a new AI system. It's called Candor. And the loan teams are able to run that when they receive all of the documentation up front. And it is able to read documentation, and it will give you conditions. It still needs to go through underwriting because we still need to have that real set of eyes on it. But it does take a lot of work out of the underwriting part of it. So yeah, it works well. We've had it about, I would say, 6 months.
Yeah.
Nice.
Yeah. So
Nice.
yeah, and
There you
it
go.
seems to it's working pretty well.
So if anything, it's giving us more efficiencies, John, which is great. Kelly asked, what type of documentation would be needed for somebody who owns their own business, and then she has in parentheses 1099, and wants to purchase a home?
So they definitely need their 1040s, their tax returns. And then we evaluate their self-employed income off of that Schedule C. We also, if it is a business, we do more validation to verify that the business is still in play, that the business is still working. And then depending on your type of loan that you're closing, you may need a profit and loss statement. Sometimes you need a balance sheet. But typically for Schedule C 1099, those are the easiest. Self-employed borrowers, we like them. They're pretty much a slam dunk because they don't have a lot of expenses typically. And we can go, off of what their 1040s show.
Perfect. And then Kelly, if you have a follow-up to that, shoot us in there. Hopefully that covered that. But I know self-employed people always have more questions about that. So let's see here. Our host has a question. So if a person owns a corporation and their car payment is under the corporation, does the payment have to be disclosed? Or, I'm sorry, and if so, does it count against the debt ratio? So I think I have, in Vienna, since you asked the question, when you say if the person owns the corp and their car makes the qualifying portion of all that is who makes the payment, first of all. Does the corporation make the payment to the car
Yes.
note?
Mhm.
Okay. And the second part, which underwriting actually just, in my opinion, started looking at probably in the last 3 or 4 years, was they not only need to see the canceled check or the proof of payment from the corporation, they also need to make sure that it's being written off in the corporate returns, because we've
Yeah.
seen situations where corporate checks are being written or business checks are being written, but the deduction's nowhere on the tax returns.
Got it.
Yeah,
Yep.
so those two, if you get the proof of the, and I apologize for, sorry, Kim and Jolene, I didn't
Oh.
wanna, that was one I just know that there was a big difference or a big change where we have to
Yep.
see the deduction on the returns.
Got
Yep.
it.
Yeah,
Got it.
did you guys want to add anything to that?
Mm-mm.
No, okay, oh, there
That's
you go.
perfect.
Future underwriting, a future career for me, anyway.
There you
That's what I
go.
was gonna
That's your
say.
retirement plan.
All right, so let's see here. Becky's got a question and it's a long one. Let's see here. So she says, if a potential client has not done their 2022 tax return as they applied for an extension, or the tax preparer is out of the country, which of course they should hopefully apply for an extension, are they able to apply for a pre-approval or mortgage application using the previous 2 years, but can show W-2 for 22 and paycheck stubs and bank statements? I have an actual client who wants to put in an offer, but can't get a pre-approval letter from you because their tax preparer is out of the country for an emergency. I gotta remember who that was, Becky, that you were talking about on that. I'm gonna look that up, but ladies, what would be the answer relative to that? And I think the issue, if I remember right, Becky, the issue is that she made a lot more money in 2022, so that's going to help her qualifying purposes, but she doesn't have returns to provide us. But I'll turn that over to the underwriters and have them speak to that.
So you do need the extension for 2022. And if the extension was not filed, if that tax preparer is out of the country, then that's probably where it might be stagnant, like you might be stuck. You do have to file that extension, and the borrower has to pay any fees that are incurred or any IRS debt that is on there,
Mhm.
listed on their extension. We have to have evidence that that's paid. So the W-2, I'm guessing that this probably is like an 1120S borrower where they pay themselves a W-2 as well. The W-2 can definitely be used, but if we're trying to also use the business income from 2022, that's where we have to tie the two together. So you can use 2021, you can use 2020 for
Mhm.
the income. But in my experience and most of the loans that we've seen, Jolene, you might want to
Mhm.
say as well, that income is not substantial. And you know that people have made a lot more in 2022 because it's back to normal.
Mhm.
Yeah,
That
back
may be the issue.
Yeah, I want to say, not having an exact memory on that one, but I want to say that we were, there was substantial income in 22, but we can't substantiate it because we don't have a return.
Right.
So we are a little bit handcuffed relative to 20 and 21. And like they said, we were just talking about this in our meeting before this yesterday, that a lot of people's income was negatively impacted because of the pandemic.
Mhm.
And there was a lot of guidelines that weren't really borrower positive at that time. Now, fortunately, we're mid 23, and a lot of that time people had off is already fading in the background, and definitely less impactful. Plus, some of the lenders of some of the agencies have actually created some guidelines to exclude those times now, which is helpful. All right, so I'm going to go to one that's on our list. Donna asks, I don't know if Donna's here, but Donna asks, why are appraisals even necessary anymore?
Well, We know that markets fluctuate, of course. We have been seeing a lot of openness with appraisals and the requirements, right? Where they're taking less documentation, or you're getting that appraisal waiver with the agencies. Appraisals are still definitely required because we have to validate that the home is meets the guidelines, the minimum property standards of each of those agencies. And that does, of course, include the interior, the exterior, any health and safety issues, and then comparables for the value.
Perfect. Speaking of dogs, we were talking about
Speaking of
dogs
dogs.
earlier. Jolene's dog just went by. All right, let's see here. Okay. Susan asks, when a file goes to underwriting, is it looked at by one person or a team?
I can take that one. What happens is it's submitted into underwriting from your loan officer. It's assigned to one underwriter, and then they start the process. They issue the approval, and then you typically have that same underwriter from the very beginning to the end, unless for some weird reason, like they take a vacation day or they're sick, and then it's assigned to someone else on our team that reviews those conditions. But typically, yes, it will stay with the same person from the beginning to the end.
Yeah, I think that's just better for the file too.
It is.
Not to have another set of eyes and have somebody have to start over.
Yeah.
That's not the way it happens in every company though,
Yeah.
but that's the way that we do it. As a follow-up on the underwriting, actually, there's like 3 in a row, so we'll cover this since it's all underwriting, and then we'll get back to some of the chat, which was follow-up on the self-employment. Susan asks, how many files do you as an underwriter look at on a typical day?
It depends on how difficult the files are. Like if you have someone that has saved up their down payment and they have a regular W-2 job, it's not going to be as difficult, say, as if you had a borrower that had 5 investment properties and they own their own business. So it just kind of depends on the file. We typically like to see, I would say between 5 and 10 files a day to be reviewed. That includes, of course, new purchases or refinances that come in, the resubmission of the files that were previously approved that we've gotten new conditions on. So it just kind of depends on the workflow for that day.
Those are good numbers to know. And okay, and actually we kind of answered Susan's other question, which was just, does the same person look at the files? Okay. Juan asks, going back to our tax return questions, are there any red flag issues for using recently amended tax returns on self-employed?
I think Juan already knows the answer to that. Like that's pretty funny. That's setting us up, right? That's setting us up a nice
There
one.
you go. I didn't know we had any shills, so I don't know what's going on.
Yes, definitely. There are a lot of red flags for amended returns. And we do have some stuff that we look at to make sure that, you know, it's valid. If there's something where we feel that the borrower may just be upping their self-employed income to qualify for the loan, we have ways to validate that, you know, it may be inflated or it may be changed for a purpose. It's not a no, like we will accept amended tax returns. There's just additional little flaming hoops that they have to go through to kind of help us determine and for us to do our due diligence to make sure that it is a valid amended return.
So in other words, you can't go back and tell your self-employed borrower, hey, amend your returns so you can qualify for more house. And really the issue beyond that is in everything we do here with Cross Country, it's not a matter of that we're picking on your borrower or trying to be mean or anything. It really boils down to, I need to make sure I'm making a loan that I can sell to Fannie Mae or Freddie Mac or gets insured by FHA or VA. If I, and specifically these guys here, if they make those mistakes, it's a problem. So if they see something come in and Fannie Mae says, hey, wait a minute, these returns don't make any sense,
Mhm.
they've at least given us some ways to verify that, those returns can make sense, and maybe people make mistakes, so we're
Yep.
not saying you can't
Yeah.
not amend your returns, but amending them for the purposes of
Mhm.
qualifying is definitely probably going to be sniffed out with modern technology today. All right. Now, Rick asks, so if there's we've got somebody that's owes money to the IRS. So they file their returns, they were late, they want to buy a house, but now they've got a $20,000 IRS bill, and it's going to have an impact on their ability to buy. I think, and I'm elaborating a little bit on Rick's question here. They, instead of having them pay the $20,000 to the IRS and now they can't buy, can they set up a payment plan? And if so, what are the guidelines around that?
Yes, setting up payment plans are always allowed and encouraged, and that is pretty much a guideline that you have to do that.
Mhm.
Where we ask for a payment being made is when it actually has become a lien, and that's for the FHA loans, and you have to have 3 months payments made on those, and they can't be paid ahead. They have to be paid each month. So sometimes what happens is if we find that they have an IRS tax lien and they haven't made any payments, then we're kind of again stalled, waiting for those 3 months to pass and them to make those 3 payments.
Yep.
Um,
We just had one of those, unfortunately.
Yeah.
I know and that's a sad thing, because the borrowers feel like, okay, I've got this set up and I still can qualify, and then they put that little verbiage in there. I think that FHA really just wants to make sure that the borrower can handle and will make those payments.
Yeah, they're committed to making those payments. So Kelly, I may need you to elaborate on this, because your question is rental credit, question mark. Is that something being recognized now by mortgage company? I'm not sure. Maybe the underwriters know. I'm not sure what she means by rental credit.
I'm gonna take a stab at it. I think she might be talking about the estoppel agreements and rental credits when you're purchasing a investment property. Maybe.
Oh, you're talking about, yeah, so rental credit possibly. Yeah, let's let her clarify that, because what we're talking about is somebody who makes an arrangement to rent to own. And that's what you were getting to. Okay, yeah. So let's make sure that we're on the right path with that. Judy asks, oh, nice. I like that. Judy asks, does the LO know exactly what the underwriter is looking for to make the process a bit more smooth?
It all depends.
Yeah, I mean, the bottom line is, and I'll just tackle that as the LO. I want to make sure that my agents and their clients have as smooth as process as possible. And in order to do that, I am constantly talking to not only the underwriters, but the processors, because they're kind of on the front line. We as a loan officer hand it to the processor, they do the due diligence, they go to underwriting, and then they're working directly with the borrowers. And if something comes up where we missed a piece of due diligence and now underwriting saying, hey, Fannie Mae's come back and they want this extra piece, well, that's going to the processor who's going to the client. But it's my job as a loan officer to stay in touch with the processor and constantly say, hey, what's changing? What's going on? And we do have operations calls here where we can get kind of an update and update on a weekly basis. Hey, these are some of the things that we're seeing, because Fannie Mae will just change the way that they're looking at something, or maybe they're deciding, hey, we're going to audit this part of the file a little more aggressively. And so for us to make sure that we're still making great loans, we have to pick up some additional documentation. So, all right. So, and did I cover that, ladies? Is that about where you thought? Okay, good.
Yep.
Dale asked, can you let us know? Oh, nice. Okay, good. I think we had this question ahead of time too. Can you let us know how FHA spot loans are working out? Any important info we know? Before I let the underwriters answer that, I want to clarify what that is. So FHA is allowing lenders to do spot or one-time approvals on a condominium association, so that we can go ahead and get an FHA borrower into an association that doesn't have the entire association approved by FHA. That being said, I'll turn it over to you guys and you guys can answer the rest of that.
So it is approved by underwriters. It doesn't go to we have a condo department as well.
Mhm.
Our underwriters go through and they evaluate the spot approvals, is what the condo spot approvals. Single unit approvals is pretty much what it is. The documentation that is needed is a lot. And there is a lot that goes into it. The most major things that I find is that because they don't have enough HOA insurability and coverage and liability coverage, that's what a lot of them don't get approved for, because that's why they don't get approved through the FHA standard process. So it is still valid, or it is still needed for those single unit approvals as well. But if you have one that you're on the fence about that you think may not work, you can always go to FHA.gov, and they have a search bar that does have single unit, and there is a checklist that can go through, quickly, hopefully quickly, of what you may need or what you know of the property that you're getting into.
Yeah, that's interesting. So I'm not sure I even knew that was there. So it's good. It's always good reason. So in Gail, the biggest thing that I talk to people about is the step number one is we're gonna, as soon as we have that contract, or if you just have that general inquiry, we're going to call the Atlanta Homeownership Center, and we're going to check to make sure that there's not more than 10% FHA loans in the entire project. Because that is the first rule, if you will, with the spot approvals, is that FHA doesn't want to have any more than 10% concentration, meaning if there was 100 units, they only want to be on 10 of them, and that's it. So we'll check to make sure that we're under 10%. And then the next thing we usually let our agents know is we really need a very cooperative management company and HOA, because we're going to ask a lot of them. We're going to ask them for paperwork that they normally don't provide. They have it, but we are going to ask a lot from them. And the smoother, easier they are to work with, the quicker we'll be able to determine for all parties whether or not we have a good association that we can work with. All right, and let's see here. So we talked about that. Perfect. Kelly is clarifying her rental credit. If you have a client that has been renting long-term and never owned a home, can you use any of the rental history or payment history as determination for the pre-approval, or will that not factor in the decision, ladies?
I'm going to reread that. I'm sorry. Hold on one second.
That's okay.
Has been renting long-term and never owned a home.
So it's rental history, essentially. They've been making a payment.
Oh, rental history. So this has changed. This is a new item that is manual underwrites, meaning that it doesn't go through the automated underwriting system. Always do require rental history. So we need 12 months minimum of rental history paid on time for those manual underwrites. And what that means is the underwriter is taking on the risk and the due diligence on their own, with their own delegations, like similar to your licenses. We have those delegations for the agency. So they have to have rental history to back up their decision on that. Loans that go through normally, that are through the automated underwriting systems, clean, fast, and easy, there is an option where we can input rental history and they can evaluate that. So if an underwriter is on the verge of getting an approval or not getting an approval, and we can get a verification of rent, we can add that on there to give them a little oomph to get over that threshold to hopefully get an approval.
Cool. We're gonna go 1-2-1 on the list, and Aqua, I'm gonna get back to yours, but Chan, I think I'm saying this right. Chan says, how is debt to income ratio determined?
It's housing expense. It's compared to your income. and also your additional liabilities. So it's a formula. You have your front end debt ratio and your back end debt ratio. Your front end is your current liabilities, and your back end is your liabilities that include your housing payment. So the front end is always less than the back end. So, and the closer they are, actually is a little more of a risk. So the little farther apart they are, the better.
Interesting.
Yeah.
So, well, that's a good one. All right, so we have, let's see here. We talked about this one too. Ilona asks, are there any new challenges that you are seeing with the current market?
Yeah, as we mentioned before, appraisals are a big thing, and I think that that's what we're always talking about. And we can talk a little bit more about how the market is changing. You guys know better than any of us how the market is, panning out, because you see it, right? You see exactly how it's happening. The credits that are now coming into play, seller credits, IPCs, that is affecting values as well. So I think that that's the number one thing. Jolene had mentioned also or maybe I had mentioned, I can't remember now. We have the same brain. That income, right? And Rich had mentioned it too, with COVID and all of the guidelines that went around COVID and income during that time. And now people are just now getting back to typically regular hours. That's a hard thing, because we look at averages, and somebody had always told me that the lenders are always looking for the past. Real estate agents are always looking at the future, and LOs are looking at the present. So I think underwriters are always looking to average those and to meet those guidelines. So I think that those are the two major things that we are always up against on our escalations or second level reviews that we're looking at. Is this, can we push back on this appraiser, like to get more value? Are these comps valid? Are there other comps that are out there? That's what we're looking at. We use Data Verify, and also we become a little bit of CSI gurus too, as we Google listings and try to see if there's any possible way when we get those appraisals in that are a little bit less, to get them over that hump.
Yeah, that's great stuff. We have a couple. Gail, I'm going to get back to your question, but we're going to stay on appraisals because I've got probably 3 questions around that too in the chat, and one that we had beforehand. So Becky asked if the property needs a lot of repair, what kind of condition will FHA approve on a property that needs repairs?
Well, FHA, as you know, is very hard on collateral. I think as you get more and more into the government loans, that they're harder on collateral. We do at Cross Country, which is different than other places I've worked, which is also why I love Cross Country. We allow for escrow holdbacks. As long as those escrow holdbacks are nothing that impede or are an issue with the minimum property requirements of safety, health, and structural, we can approve those all day long. So if you have chipping paint outside, no problem. If you have a house that was built in 1942 with chipping paint on the inside, we want something done before we close. So that's a little bit of the difference there. But if it is structural, meaning like the roof is caved in, it's something that we would not do an escrow holdback on. If you have a foundation that is cracking and the cracks are not detrimental at this particular moment, we can look at doing an escrow holdback. I can't promise anything, but those type of structural things we wouldn't do. Broken windows, as long as it's as long as it's covered, we've done those before. And of course, on new builds, we do a lot of escrow holdbacks, because we know in Illinois the weather is not perfect in December to put in everything that we need. So
Grass, driveways,
and even last year, I think we were missing some garage doors. So, as long as we can make sure that the house is safe and that they are locked, it's something that we would do.
Yeah, and to follow up on that, Becky, I think this is probably one of the most flexible companies when it comes to repairs because our willingness to escrow. We not only escrow, but we actually are the one that maintain those funds. So because we want to be very involved in making sure the homeowner gets the work done and they get everything the way it should be, whether it's a new build or that. And then obviously in some of the major things that we're talking about, the loan just pivots to some sort of renovation product, and we do every renovation product that's available through the agencies. So from a repair standpoint, very, very flexible. On the appraisal side, I'm not sure I understand Judy's question. It says, Judy asks, has large appraisal gaps ever made it so someone couldn't qualify for a loan anymore? I'm not sure if she's asking like, yeah, I mean, you might want to clarify, unless you ladies know, I'm not exactly sure what the question is.
I don't quite understand it, but
If the appraisal comes in low, then you're gonna have to renegotiate your contract, so.
or the borrower's gonna have to come in. with
Yeah,
that.
or the borrower's gonna have to come in with the difference.
Mhm.
Yeah, I mean, if
So
we're talking about.
I'm not sure if that's the question.
Yeah, I'm not sure if that's the question either. I mean, there are some creative things that you can do out there relative to low appraisals. We had one recently where the purchase price was $450. The client was pre-approved. You know the file, Kim.
Yeah.
There's new construction. Unfortunately, it's the first home in the subdivision, first home of that type in the neighborhood, and appraised for $380. The client still came in with 20% down, and on our world, they ended up with a 95% LTV, and the builder gave us a credit to buy out the mortgage insurance. So their mortgage looked exactly like it would have had the property appraised for $450, and they understood what they were getting into just relative to being the pioneer, if you will, in that neighborhood, in that area. So an under appraisal isn't necessarily always going to be the death of a file. You just need somebody to be really creative. Okay. So Judy clarifies. So if they sign the appraisal waiver, so they sign an appraisal waiver, which means that they're basically told the seller, hey, we don't care if it doesn't appraise, we're still going to buy it.
Yeah.
And I think that boils down to, Judy, can they make up the difference? Are they going to be able to make up the difference between where it's shorted and what they agreed to pay the seller? If they cannot make up the difference, then yeah, technically they could be in breach of contract, because we're going to lend off the lower of two numbers, sales price or what it appraised at. And if they've told the buyer, they told the seller that they're agreeing to pay the difference, they better figure that out, or they are in breach of contract, unfortunately. I don't know if you ladies want to add anything to that part of it.
I hated those appraisal waivers and inspection waivers, just to be honest with you. And I know that the rates were low and everybody was grabbing as they could. I think that and you guys could tell us better too. I think Rich had this conversation with us probably months ago, that when rates started to go up a little bit, we in operations were freaking out. But then it took somebody with a sales savvy point of view saying, even though rates are going up, the borrowers are still going to be paying better for their mortgage, because they're not overpaying, because they're waiving those appraisals and inspection and having that undue cost and lack of equity when they move in. So you guys know the market balances itself out, but I'm glad we're kind of getting there. I wish our rates were lower nationwide, but man, I'm glad we don't have any of those appraisal waivers. There were a lot last year at this time. I can just remember having to validate a lot of loans that needed cash to close, and people were getting a lot of gifts because those appraisals were low.
So one last appraisal thing, and then we'll get up to Gail's question. Ilona had asked, how are appraisals issues being handled most commonly? And I think we kind of covered it. So when we're talking appraisal issues, most likely what we're talking about is shorting the values. So appraiser wasn't able to make the mark. which was a little bit of our appraisers' concerns, conversations I had with appraisers in January and February and March. They started to have some concerns because the market here in Chicago flattened a little bit, where, we didn't have that appreciation. And yet, so they were worried that they were going to have an issue trying to bring appraisal values in. Now, since then, we're back to multi-bids and everything else, and that problem will correct itself. But as long as there's comps there, and we will eventually do a class, which is our Ask the Appraiser class, and you guys can really drill down into what these guys are looking for. But if you can give us a comparable property to the subject property, that would be really helpful. All right, so Gail says, I guess I could tackle this one. On the other side of, so with the IRS, what happens when the seller has an IRS lien? That's one of the reasons I love purchases over refinances, because that is not my issue. So I am only concerned about what my buyer has to deal with. That is the seller's attorney, the listing agent. That's all their problem to clear that lien up.
Yep.
So hopefully there's enough equity, or the seller has the means to clear up their IRS lien so that they can go ahead and transfer the property over. Now, I do think that there is a way to go to the IRS and get an exemption if they're in a payment plan under lien. They could probably get a letter from the IRS that says, yes, our lien does not impact 123 Main Street that John Doe is selling, and that would allow them to sell without curing the lien. So they have a little bit of flexibility in that. All right, so we've got other questions here. Let's go with Kenyatta's. She's got an interesting question. So she's had some deals fall apart, and she's asking, are there any measures in place to secure funding or avoid the last minute run around to try to gather documents? How do I, as an agent, spot early on bad financing? I want to address that a little bit too, because many of those things are really start with the loan officer. When you're talking about things to secure funding, one of the things Cross Country does, were they doing fast tracks when you got here, Kim, 5 years ago?
Yeah.
Okay. So we had started it at least 5 years ago, and we were the only ones doing it. Now it's been copied, which is fine. But we started fully underwriting loans at the pre-approval, so you didn't have any kind of running around. The second part of it is, if you end up having to be reconditioned and re-stipped, and they go back to your client over and over and over, honestly, that starts with the loan officer and or their processor. They're not providing enough. They're not asking for the right things to give the underwriter the right packages before we submit. I'm very blessed. I have some amazing processors here, and I believe we have great processors throughout the organization. But if the processor and loan officer are doing their job, your client's never going to feel like they're piecemeal. Now, I will warn all agents here, there are some clients that if we ask for standard documentation, they literally feel like we're assaulting them emotionally. It's crazy. I've actually got that quote from one of our realtors recently, which is crazy. But the fact of the matter is, I don't want to ask for any more documents that I need. But if I'm coming back and saying, oh, the underwriter wants this, oh, the other writer wants this, oh, the other underwriter wants this, then that's just a breakdown of the entire process. And I'm very blessed. Why I've been here 11 years is we do not have that here within our organization. As a realtor, how do you spot that? I think it's just a matter of, company reputation, loan officer reputation, maybe some basic questions you can ask to the borrower or the buyer that says, hey, when you talk to your loan officer, this is a great tip for you guys. When you talk to your loan officer to get pre-approved, did you actually provide him a paycheck stub? Hey, I noticed you're self-employed. Did he pre-approve you after he looked at your tax returns? because that's a huge problem,
Yeah.
issuing a pre-approval without putting eyes on a tax return.
Yeah.
Huge problem. Ladies, I don't know if you want to add anything to that, what could help an agent out, but unfortunately, I think it starts with us before it even gets to you guys.
Yeah, I mean, I think hearing from other loan officers and also speaking to other agents as well, it does feel like sometimes, even when we all do that, when we all get our own loans, right, you do feel a little accosted, like, what else do you need? Like, what else do you need? And even as an underwriter, like when I did my refinance, it was like, I've already explained all of this stuff, but they wanted it again and again. So I think that most of the loan officers do a great job of telling those borrowers at application, like, you and I are going to be best friends for the next 2 weeks, because I'm going to be calling you, asking you for a lot of things. And because as you know, when you get something, it opens up another Pandora's box, and it opens up another Pandora's box. And especially in this market, people have a lot of stuff going on, and a lot of stuff with their finances, and a lot of stuff with their credit. And so it does become a little overwhelming when you get those phone calls and those emails. And I think just, being supportive of the borrower and letting them know, yeah, this is going to be a tough 3 weeks. Let's get through it together. I think that that's what most good LOs do. And let them know that it's not a slam dunk, right? We're in this business. We know.
Yeah.
Yeah, that's great stuff. That's great stuff. So I'm going to put it out there for you guys. If you have any other questions, we did have one, and I'm going to let you guys answer this. Aqua and Teresa kind of asked kind of a general question, and I don't know, Tony, if we ever got a better explanation, because we were going to go back to them for a little more specific question. Tony, did we ever get that from either one of those?
We did.
Oh, okay. Where did you find that? Because I don't have that on the sheet.
Hang on, I sent it to you.
Oh, okay. It's always my fault. Tony's on it, trust me.
Hey.
He's on it. Her fiance and I have learned never to question her. So
That's right.
So
Smart men.
There you go. Yep. Never question her. So while I'm looking for those other questions to get answered, I want to let you know, Kim, you now have to get your license, because there's not one but 2 people in the chat that are ready to buy a house from you in Denver. So
I know. I have to.
And I just want you guys, I know, that's right. And I just want you guys to know, we can finance the house right here. That's right. Even though you're going to buy in Denver.
I will not underwrite it if I'm the realtor, but I will, I'll help get you in, right? Like, I gotta keep my nose clean.
There you go. So we got you a couple clients. Tony, where did you is that in your must read, Tony?
Hang on, I found it. I'm about to send it to you in the chat.
It wasn't just me that had a hard time finding it. She put it in here. Oh, okay, here we go. Put it right in the chat. So I would like to know the actual steps of the underwriting process from beginning to end. Boy, I don't know. We might have to have another hour.
Yeah,
I've been having issues. Let's see if we can drill down. So she's been having issues with loans falling through once it gets to underwriting. When does underwriting determine if the loan will actually be approved? I'll receive a pre-approval letter from the buyer's agent, then it'll end up falling through once it gets to underwriting. Interestingly enough, we kind of covered that a little bit in the sense that you got to have a good loan officer. And honestly, that was that from Aqua or Teresa, Tony?
I think
that one came from Aqua.
Yeah,
that was from Aqua. Okay, so I mean, Aqua, I think you got to ask the buyer a couple of questions around what was done to generate that pre-approval letter. Because I know some people, I know pre-approval letters that have been written. I've picked up the deal and I don't even see a credit pull. And I'm like, how do you issue a pre-approval letter without running somebody's credit? I mean, we've seen some pretty appalling things, and really, it boils down to how good is the loan officer at putting a file together, knowing their business. And then guys, there's no reason a pre-approval shouldn't be fully underwritten today. unless your buyer called me today and they got to look tonight, I should have time to go fully underwrite that. So we are right at 1 o'clock. Ladies, I'll let you add anything to that. I'll be right back.
I'll just tell you real quick, the underwriting steps, right? What does happen is it comes in from the loan officers and the processors, and processors do a great job of getting those documents in prior to, of letting us have the documents that make a credit decision. Underwriters then take a look at it of what type of loan the borrower wants, what the loan officer has put into it, and then, oh my gosh, so cute. And then we issue the approval. The approval goes out. Conditions then are gathered by the processor and then come back into us to give you a clear to close. So what happens, Aqua, in the middle of that is if stuff comes in that does not fit in the box that we thought we needed in the beginning, then that's where it comes into restructuring and kind of finagling to make sure that we get it to where we need to be at CTC. And that is happening more and more. Just as I said, deals are more complex these days, but you know, asking the right questions up front alleviates that all the time, which Rich does. I can't even tell you how many times I get a call at 4, 5, 6 o'clock from Rich saying, hey, do you think this will work? And we run through it, and it's well before a borrower has even looked at an application. So the due diligence is always there with your team. So Rich Charlie is so cute.
Yeah, there you go. So I had to, and we talked about dogs, and I'm going to add you're going to make him famous. So that's Charlie. So he's our little mascot. So it's pretty funny.
Charlie.
So, well, thank you guys all for attending. Ladies, thank you very much for your time. Vienna, thank you for the sandwiches.
Thank you.
Thank you.
Kim,
Thanks for having me.
Oh, sure. Thank you very much. Kim, congratulations on the couple of sales that you made. So, and I appreciate the time, everybody. And Tony, without Tony, this never gets done at all. Our next webinar is for clients, but agents are welcome. We are doing a class Saturday morning on budgeting. We do a quick 30-minute budgeting class to help you out. If you want more information on that, Tony's put that in the chat, or reach out to us. Guys, thank you very much. If you want your loan approval to be right, start with us here at Cross Country. Have a great one, guys.
Thank you.
Thank you.
Bye, guys.
Bye, guys.